Hello, student. I'm Dr. Shafali Jain, Assistant Professor, Tirthankar Mave University. Student, today we discuss about the total cost, average cost, and marginal cost. In the previous video, we also discussed about the accounting cost, explicit cost, implicit cost, economic cost. Total cost is the total expenditure incurred by the producer produce his goods. Total cost is also summations of total fixed cost and total variable cost. It means total cost को आप हिंदी में कहेंगे कुल लागत। टोटल कॉस्ट एक तरह से पूरा समीशंस होता है जितनी भी टोटल फिक्स कॉस्ट हमारी हुई है और जितनी हमारी टोटल वेरिएबल कॉस्ट हुई है। इस तरह से total cost is the simplest terms we can say all the cost incurred in producing something or engaging in an activity. In economic, total cost is made up of variable cost plus fixed cost. Total cost, variable cost plus fixed cost. Variable cost, I have also discussed about the variable cost in the previous videos. Variable cost are cost that change based on how many goods you buy or how much of our services you use. So total cost is evaluated as follows. Total cost is equal to cost per unit multiply quantity produced, and you can say also total cost, total fixed cost plus variable. So we can say the total cost refers to the overall cost of production, which includes both fixed and variable components of the cost. In economics, the total cost is described as the cost that is required to produce a product. Total cost is composed of two components, which is fixed cost and variable cost. What is fixed cost? I have also discussed it in the previous video, but in this video, I also discussed it briefly. Fixed cost, it is the cost that are constant. In other words, these are the costs that remain the same and irrespective of the number of units that are being produced. For example, the lease for a uh, building or the rent for an apartment, interest, etc. And variable cost is the cost that changes, that increase and decreases based on the number of goods produced by a company or the service requirements of the customer. So we can say total cost in an important indicators of the financial performance of a company. This can show if a company is spending too much money on certain processes and if there is a need to cut down the cost. So, total cost formula can be represented as I also written here on the SLM. Total cost is equal to total fixed cost plus total variable cost. And it also represent in a more advanced way if you say total cost is equal to average fixed cost plus average variable cost multiply number of units. So in this types you can find the total cost. So we can say that total cost defined as follow. Total cost is the cost which is incurred by the producer to produce a particular quantity of the commodity. It means total cost in economics, the sum of all cost incurred by a firm in producing a certain level of output. It's typically expressed as the combination of fixed cost. I have also discussed about the fixed cost, the cost of building and heavy machinery, rent, interest, which do not change with the quantity of the output produced, and all variable cost, the cost of labor and the raw material. which do change with the level of output. If fixed costs are not altered by obtaining a larger building or by acquiring more heavy machinery, the rate mm, the rate of increase of variable cost with increasing output will be progressively greater in the long run, moving to diminishing returns on additional units of output. In other words, in the long run, fixed cost also become the variable cost. The notion of total cost is used to define average cost. Average cost meaning I will also discuss this in the further of the video, but I also explain it in the briefly. The average cost of a unit of output is the total cost divided by the number of unit produced and marginal cost. The marginal cost of a given unit of output is increased in the total cost required to produce that. So we can say that total cost is the monetary value of goods and services uh, purchased by a producer purchased by a producer to make any things of and service. So the total expenditure incurred by an organization um, on by an organization on the factors of production which are required for the production on the factors of production which are required for the production of a commodity is known as total cost. In simple words, you can say the total cost is the sum of total fixed cost and total variable cost at different output level. So, uh, total cost is the summations of the fixed and variable cost. Now, we also discussed about the fixed and variable cost in the previous video. Now, the uses of total cost. It helps in economics of scale as a producer needs large amount of raw materials for large productions, and it is helpful in pricing policy and helpful in decision making. So, in economics, total cost means total cost of production that includes total fixed cost and total variable cost. Total fixed cost include salaries of employees, wages, rent of buildings or equipment, interest on capital, and interest on loan, etc. Total variable cost are raw materials, electricity, daily labor, and stationery or office expenditure. So, if I think you have properly understood what is the total cost. Now, we discuss about the average cost. Um, an average cost, an average cost is the expenditure incurred by the producer for producing each unit of the product. Average cost is the per unit expenditure of the producer. So it is called also per unit expenditure, per unit expenditure cost. Average cost is also the summations of the average fixed cost and average variable cost. So average cost is evaluated as follows. Average cost is equal to total cost divided by quantity produced. Average cost also find out with this average cost is equal to average fixed cost AFC plus average variable cost. So average cost is defined as follows. Average cost is the expenses incurred by the producer to produce one unit of the total production. So the per unit cost explain the average cost, the relationship between cost and the output in a more realistic manners. From total fixed cost, total variable cost, and total cost, we can take uh, and the three kinds of sorry I am disturbed, sorry. Average fixed cost, in the average cost, we can also study average fixed cost and average variable cost. Average fixed cost refers to the per unit fixed cost of the production, and it is divided by dividing uh, TFC by total output. And average variable cost refers to the per unit variable cost of production. It is calculated by dividing TVC by total output. So average cost equal the per unit cost of the production, which is calculated by dividing the total cost by the total output. Total cost means the sum of the all cost, including fixed and variable cost. Therefore, average cost is also often called the total cost per unit or the average total cost. So the average cost is the average price of goods and services. When we have multiply product to sell or buy of at most the same value, the average of these values will give the average cost price. It helps shopkeepers in the buying and selling process. Average cost is the ratio of the total of the cost of all product to the total number of product. In maths, we also have the terms called average. The average of any given set of data is called the mean of data. So, average cost, to calculating the average cost, formula will be average cost is equal to total cost of the units and divided by number of units. So, the average cost is the, you can say that average cost is the expense incurred by the producer to produce one unit of the total production. So, in simple, we can say that average cost refers to the per unit cost of production, which is calculated by dividing the total cost of production by the total number of units produced. In other words, it measures the amount of money that the business has to spend to produce each unit of output. It forms a fundamental components of demand and supply that affect the supply curve, and it is also known as unit cost or average total cost. Now we discuss about the uses of the average cost. Helps to cut down excess expenditures as per unit cost is calculated. I have also discussed it. It helps in optimum utilization of resources and help in pricing strategy. So the concept of average cost, we can say, helps determine the amount spent uh, per unit of an item. It's widely used in various contexts of finance or business to measure the price of products, expenses incurred to produce them, or the profit level that can be earned from manufacturing those products. Average cost method account for the per cost including the fixed and the variable ones like rent, salary, labor cost, raw material cost, etc. The average cost is calculating by dividing all the cost incurred for a process by the number of units produced. So the inventory valuations and accounting process uses this concept to determine how much inventory storage is profitable, how much might lead to excess or wastage of the resources, what is the minimum or maximum level of to be maintained, etc. This helps manufacturers plan their production process, and business analyze this cost to control wastage and earn maximum profit. Product pricing is the most important decision of the business, which depend on the cost. In this way, producers take informed business decision, thus contributing to their profitability. Overall, The knowledge regarding average cost method in the finance and business environment helps in decision making, budgeting, and increasing the profitability of the company. So I think you well understood what is the average cost and what is the uses of this cost. Now we discuss about the marginal cost. Uh, Marginal cost. Marginal cost is the expenditure incurred by the producer to produce an additional or an extra unit of the commodity. Where the marginal word is used, it is the additional or extra units. Marginal cost is the cost, additional cost incurred for producing one extra unit after producing certain amount of units. So, in economics, marginal cost is the change in total production because it is the additional cost. When we use an additional cost, what changes income in the total production? So, marginal cost is the change in the total production cost that comes from making or producing one additional unit. To calculate marginal cost, divide the change in production cost by the change in quantity. The purpose of analyzing marginal cost is to determine at what point an organization can achieve economics of scale to optimize production and overall operations. If the marginal cost of producing one additional unit is lower than the per unit price, the producer has the potential to gain a profit. So, in short, we can say marginal cost is an important concept to managerial accounting as it can help an organization optimize its production through economies of scale. A company can maximize its profits by producing two where marginal cost equal to marginal revenue. Fixed costs are the constant regardless of production level. So higher production leads to a lower fixed cost per unit as the total is the allocated over more units. So companies must be mindful of the fact that increasing production necessity staff cost due to change in relevant ranges and additional machinery or storage. So marginal cost is calculated. The formula is also given here. Marginal cost is equal to total cost number minus मतलब total cost to minus total cost and minus one. It means जो additional cost यूज किए उसको माइनस कर दिया जाए टोटल कॉस्ट में से. Marginal cost is calculated as the total expenses required to manufacture one additional goods. It means therefore it can be measured by changes to what expenses are incurred for any given uh, additional units. And you can also see marginal cost is equal to change in total expenses divided by change in quantity of units produced. So the change in total expenses is the difference between the cost of the manufacturing at one level and the cost of the manufacturing at the another level. For example, management may be uh, incurred 1 lakh in the current process. Should management increase production and cost uh, increase 1000, the change in total expenses is will be 1 lakh minus 1000. So the change in the quantity of units is the difference between the number of units produced at two varying level of production. Marginal cost strives to be based on a per unit assumption. So the formula should be used when it is possible for a single additional unit to be produced. Um, so I think you have to understood what is the marginal cost, and marginal cost can cost is the cost or expense incurred for producing an additional or an extra unit of commodities. It is also helpful, just help in decision making, help to determine cost for each commodity, help in planning profits. Student, hope you well understood what is the total cost, what is the average cost, and what is the marginal cost. Now we distinguished between total cost, average cost, and marginal cost. First of all, we discuss about the meaning of total cost, and I have also discussed it in this video. Meaning, total cost is the expenditure incurred to produce a bulk, means quantity of the commodity. Next, average cost. Average cost is the expenditure incurred to produce one unit of the commodity. And marginal cost is the expenditure incurred to the produce an extra or additional unit of the commodity. Now definitions. Total cost is the cost which is incurred by the producer produce a particular quantity of the commodity. And average cost is the is that expense incurred by the producer to produce one unit of the total production. And marginal cost is the cost or expense incurred for producing an additional or an extra unit of a commodity, and it includes uh, uh, total cost includes it includes total fixed cost and total variable cost, and average cost include average fixed cost and average variable cost, and marginal cost include only the cost for producing an extra unit. Hope you have to understood it well because I have discussed it. Calculation, it is calculated into two way. Total cost is equal to TFC plus TVC. Yani total fixed cost plus total variable cost. AC is equal to average cost is average fixed cost plus average variable cost. MC is equal to total cost minus total cost minus extra additional cost. So it is the graph. It's always go up, and it's a U shapes, and it's also half uses. Uh, it helps in economies of scale as a producers needs large amount of raw materials for large production, and it has to cut down excess expenditure as per unit cost is calculated calculation and helped in optimum, and this helps in decision making, help to determine cost for each commodity. So, student, I think you have to well understood what is the distinguish between the total cost, average cost, and marginal cost. So, main difference between the marginal and average cost, the change in overall cost that result from increasing the amount produced or the cost of producing more is known as the marginal cost in economics. And it might mean a unit of output increment in some circumstances or the rate at which the total cost changes while the production increases by a negligible amount. So, student, hope you understood well what is the total cost, what is the marginal cost, what is the average cost. Thank you. Thank you very much.